More on Tech's Bad Week. Let's bring in James Lee from Mizuho Securities. And James, you upgraded a number of picks, or at least picked out a lot of favorites today based on valuations that you say look attractive amid this sell-off. Which ones do you like?
Yeah, thanks for having me. There are three picks we really like in the U.S., and given the fact that in a rising environment, we want to look for friendly valuation, growth at a reasonable price. And number two, we want to make sure the fundamental hurdles going to FY22 is reasonable. We like three names here. Amazon, they went through a very tough 23 points of revenue tough comp last year. So therefore, I think the comp going to the back half is going to be relatively easy. And also Uber, last year they were facing driver shortage. So they lowered their take rate and causing a 15 points of top revenue comp first half of last year. So the comp's going to be easy as well. Facebook clearly went through, Apple's advertising privacy policy change. And we think the comp's going to be a lot easier from the revenue perspective by 25 points in the back half.
So you're picking the mega caps, which have held up better than some of the other tech stocks, the growthier names, the less profitable names, but have been dragged into the selling, James. Isn't that a risky bet for 2022 when everyone's expecting the Fed to hike interest rate 3 times and potentially shrink the balance sheet as we've gotten more and more clues, including jobs today and Fed minutes on Wednesday?
Yeah, that's a fair point. And that's why in a rising rate environment, valuation matters. And when we look at these three stocks specifically, their valuation level, they're not stretched. They're not trading on price to sell. They're trading on 2-year forward EBITDA. And if you're looking at for the group specifically that we track within our universe, from EV to EBITDA 2-year forward basis, actually declined about 15%, since midpoint of the year to about 12 times. From that perspective, the valuation seems to be very reasonable. For Amazon right now, it's actually trading below the historical level. Uber is more the valuation play. If you look at Uber valuation on the 2-year, if you look at FY24 EBITDA, it's actually 14 times. Much more reasonable than its peer, DoorDash at 44 times. And if you look at Facebook's trading about 10 times, 2-year forward EBITDA. And this is a very, very much a discounted level compared to growth of 20%. And also you get the metaverse business as a call option. So from that perspective, we think it's a very good entry point to go into.
Uber, James, you say Uber's on 14 times PE.
14 times 2024 EV to EBITDA.
Okay, so but on a regular PE, if it's still pretty steep in the 30s, 40s.
Oh yeah, that's right. That's right. I think most of the investors right now, the first benchmark for a company who spends a lot of money on CapEx and also on depreciation in general, first metrics have definitely EV to EBITDA. So at this point in time, compared to his peer, look at DoorDash at 44 times, given the fact that the business composition is very similar, I think Uber represents a very good value. Another catalyst we should think about for Uber specifically is potential regulatory relief on the state side. We're seeing Massachusetts and New York potentially going into the path very similar to Proposition 22, meaning gig economy workers, they stay as independent contractors with limited benefit, and this will lift a major overhang for the group, not only for Uber and also for Lyft as well.
So those, James, are your picks here in the US. What about the Chinese internet names that I know you cover too? Are they very attractive given the pullback they've experienced, or is there a lot of risk with them still?
Good question. From the valuation perspective, even more attractive than the U.S., right? If I look at our index, since first quarter of 21, it's down more than 50%. And it's clearly on regulatory concern. Now, the key thing to watch here, we expect policy climate to start to become stabilized and economic initiative to start easing heading into inauguration in the second half of 2022. And as a result, we think the industry multiple is actually positioned for a rebound.